So I'd like to introduce Robert Basen, Senior Vice President with Coldwell Banker Commercial. He's going to dive into the industrial market here locally, which Dan did talk about not only locally but nationally. If you haven't seen a small building on I-15, about 1 million square feet, you've been locked up at home too long. Industrial's exploded, and Bob's here to talk about it. Please welcome Robert Basen.
Good morning. Okay, so we are now getting into our local real estate market, and we're going to start off with a very exciting subject, in my opinion, is our industrial market. 2021, we gave this report, and it was exciting, and 2022 did not disappoint. Okay, so what happened in 2022? We have three things that metrics that we measure that gives us an idea of the health of that particular market. Our vacancy rate, lease rates, and absorption rate. In 2022, our vacancy rate was an insanely low 2.2%, which was down from an insanely low of 3.2% in 2021. Lease rates went up to $1.01 per square foot. That was up 38% from a rate of 78 cents per square foot in 2021. And our absorption, 2.5 million. In 2021, we had 1.3 million. So you see all three of those metrics are in the green. That green is there for a reason. So as we get into this presentation, and we're talking about the industrial, and I just want you to keep in mind, don't dwell on it, but something to think about afterwards, that for every 1 million square feet of industrial building that we have, it creates approximately 1,000 new jobs, and how that affects the rest of the high desert. Okay, so the existing industrial space that we have, how it's spread out across the Victor Valley, the high desert. Adelanto has just over 5 million square feet. Apple Valley just over 4 million. Barstow about 1.3 million. Hesperia 6 million. Victorville almost 11 million. And the rural unincorporated areas 135,000 square feet. So let's talk about the first two metrics, our rents, the lease rates, and our vacancy. So you can pretty much see that from 2000, we've had, if you drew a straight line, we've had a trend where the gross rents have increased. We did have during the Great Recession, we had a little bit of a dip, but you can see in 2016 that industrial gross rents started going up. Now, one of the reasons, the big jump in 2016, the cannabis industry kind of took off, and those lease rates that they could pay were considerably more than non-cannabis. But you can see that 2016, 17, and 18 were pretty close. 19, we had a huge spike, and again, that was primarily due to the cannabis industry. Whenever you see a big spike like that, there's generally some sort of an anomaly that happened, a big deal that would affect the whole year as far as the numbers are concerned. 2020, we had a little bit of a dip. We blame that on COVID. We blame everything on COVID in 2020. 2021, you can see that we were on our way back up. And then 2022, we had the big increase in our industrial rates. Now, you can see the reason for that is you can see these vacancy. The vacancy pretty much continues on a downward trend since 2000. Obviously, during the Great Recession, we had a trend up in vacancy rates, but that lasted for 1 year, and then you can see they started going down again. And that's what got us where we are today. There's a huge demand on space. We have very little space available. That creates these the very low vacancy rates, and then that's where we got that big 38% increase in lease rates. Net absorption, deliveries, and again vacancy. You can see absorption and net deliveries, again, from 2015, which I believe was the official end of the Great Recession, you can see we pretty much had a trend of everything going up, except for 2020, COVID again. But of course, in 2021, we had a great big rebound. What I find interesting in this chart is that the projections for beyond 2023 on, you can see that absorption and deliveries will still continue, but what may be alarming to someone is that you'll see that vacancy is projected to start increasing in 2023. But if you look at that chart, you'll see with that vacancy going up, where does it plateau? Right around 6%. A normal market is 10% vacancy. So we're still 40% below what normal vacancy would be. That being said, we should be able to sustain the rent increases, the income increases and growth that we've had over the last couple of years, and that we should be able to sustain continued rent growth. Now, 38%, no, that's not going to happen. But that 3 to 5%, we should be able, that should be sustainable for sure. Sales volume and the price that buildings have sold for as measured as a price per square foot. Again, you can see from 2013, the trajectory is pretty much straight up. 2021, you see a huge jump. Again, you get into that anomaly. In 2021, Sterling Prologis sold to Covington for $270 million, the SCLA assets. That number in itself, that purchase is in excess of, well, close to twice what we would normally do in a whole year for that market. So there is a spike there that if that sale was eliminated, it would be more of an even line going across the board. 2022, you see the volume decreased. You know, you ask yourself, where are the investors and users losing some interest in industrial? The appetite for industrial is ferocious. The reason the volume goes down is because there's nothing for sale. People want it, there's nothing for sale, and that's why you see that price per square foot is going up. It's a supply and demand. That's what it comes down to. You have a lot of people want it that have money, and there's not very much for sale. Now again, that price per square foot, you see a big spike on that going up to $260 a foot. Again, another anomaly. There was a couple of cannabis-related buildings that sold for a lot of money per square foot. But anyway, so that's where we are on that. So some of the exciting things that happened throughout the high desert in the different municipalities, Atlanta, they added 50,000 square feet to an existing facility, and that 50,000 square feet facilitates almost 100 additional trucks. Keep that in mind when we start talking in the million square feet. Apple Valley, this is exciting. Apple Valley, town of Apple Valley, they annexed 1,300 acres in North Apple Valley. 978-acre industrial zoning overlay was approved in the North Apple Valley for fulfillment and distribution. Now, fulfillment and distribution, that's the Amazon fulfillment, the Walmart distribution centers of this world. We're talking big, big buildings. And without surprise, with all this new land that's available, plus the existing they have over by the airport, there's an additional 5 million square feet that's in development discussion. Barstow, now you're going to hear a lot more about this Barstow, but this is big. The expansion of the existing facilities there, you're going to have what's called an integrated rail, intermodal, and warehouse for transloading. Big, lot of words. That encompasses 4,500 acres that the BNSF, not so secretly over probably the last 8 or 9 years, has been accumulating in Barstow. That project alone is supposed to create close to 20,000 new jobs. I think Barstow has a population of around 35,000, and we're going to add 20,000 jobs. That should do wonders for their housing market. I believe there's a new track of homes that is under construction now. Hesperia completed 1.1 million square feet in 2022, 3.9 million under construction, 2 million square foot permitted, and 12 million under entitlement. Victorville, the Amazon building, which we talked about last year as an approved project, was completed in 2022. They opened up in the first quarter of 2023. That's right now. Got 1 million square feet under construction. In the Foxborough industrial area of Victorville, 250 square feet under construction with an additional 2 million square feet in discussion. Some notable sales in the high desert last year. The new Amazon hub on Bear Valley Road, that's 126,000, just over 126,000 square feet, sold for $57.5 million, $454 a foot. Those are numbers we haven't seen or don't see in the high desert. What's interesting about this particular property, I was involved in the sale of this property in 2015. Now, let's say not this property, but this address. There's been a lot done to it to get it up to that $57.5 million. We sold it for $2.7 million. Okay, the former glass plant. Now, this is a factory that I came up here in 2004, and I believe this building's been vacant since I've been up here, maybe 2005. It's been on the market all that time. It did sell once in between, but it's been on the market for years. Well, last year, it became a very popular property. They had multiple bidders on it, and ultimately, Rhinotex bought the building for $16.25 million. Adelanto had a building sell in their cannabis zone, $6.8 million, almost $200 a square foot. So, where we are and where we're going, vacancy rates declined to 2.2% from 3.1% in 2021. Lease rates, asking lease rates increased to $1.01 per square foot, like we mentioned. The sales and lease activity in the cannabis zones did decrease somewhat in 2022. Our new deliveries, new buildings that were delivered, just over 2 million square feet, which was a 112% increase over 2021. We had 2.1 million under construction in 2022, almost 2.5 million in net absorption, which is a 46% increase over 2021. Here's an important one, the sub 50,000 square foot, the smaller format industrial, the vacancy rate there is well under 2%. I mean, there's no new inventory that's been built, and the demand on that from local businesses and businesses coming from up the hill that cannot afford the lease rates just right down on the other side of the Cajon Pass, much less LA and Orange County. So you're going to see, that's one of the reasons our lease rates have increased so substantially last year. Got 5 million square feet under development, an additional 14 million in entitlement, and lease rates are anticipated to increase continually while vacancy rates remain low through the future. Again, I'm excited. I feel like I'm in the right place at the right time finally after 70 years, and I'm looking forward to this. So, thank you much.
I got to apologize to Bob. He came out here and had to go through some slides, and that's because I was supposed to do an intro on the overall market. So I'm going to go back a little bit and dive into this. And what's interesting is when I was preparing for this, I went through last year's notes. And last year's notes, we're ready actually, if you can put that on. It was 2021 review and 2022. And the top of the note was COVID. We were just getting over it. We were starting to return back to business. We had economic expansion. We had market expansion in real estate. We had low interest rates, low cap rates. We had a housing boom. It looked good. 2022, we start off with a war in Ukraine, high inflation, economic slowdown, interest rate hikes, a slowing housing market, and a labor shortage. COVID's not looking so bad now. I'm not a proponent to bring COVID back. I'm just saying. But let's talk about some of the good things that are happening in the market and why the high desert is positioned significantly different than the previous recessions. Yes, I said recession. I mean, that's all they talk about on the news today. I was here in the recessions in the late 70s, early 80s, the 90s, and that little recession that we had in 2007 to 2009 that didn't cause any damage up here at all. Maybe a little breakage. We have extremely low unemployment. As you're going to hear further today about the job creation, we have approximately 25 million square feet of industrial either under development, in planning, or in permitting, or being discussed. For every million square feet of industrial built, it creates 500 direct jobs and 500 ancillary jobs. That's 1,000 jobs for every million square feet built. Times 25, that's 25,000 jobs. BNSF's talking about 20,000 jobs. Brightline, 1 or 2 jobs, right? We got a lot of activity up here. Across the U.S., we've had increased manufacturing. In this slowdown, we've increased U.S. manufacturing. We are still short 4 million homes in the United States. The millennials did move out. They just can't find houses. Since post-World War II, the start of 2022, Americans had the highest percentage of home equity. That's multiple generational highest home equity number. Credit ratings were at the highest level. They ended 2022 at 718 points. If you look back in 2006, 2007, we didn't have equity in our homes. We didn't have a high credit rating. We were overbuilding. My dog could get a loan for 125% of home value. It was just absolute stupidity. And on top of that, we started off 2022 at the highest personal savings rate. Now, granted, there might have been a little money from Washington that helped, I don't know, fuel the savings accounts. Even with a drawdown by the end of 2022, which is approximately 32%, it's still significantly higher savings rates in America. So we have headwinds, but I think we also have some good tailwinds. Now, I'm not going to get in the economics of the economy. We have an expert coming in about an hour and a half, Dr. Chris Thornburg, who'll dive into it, and he'll give you a lot more detail than myself. So this is a 22-year chart of commercial real estate and land activity in the high desert. I show this every year. I love that vast chasm in the middle. That was that little tiny recession we had from 2007 to 2027, it felt like. But what's really interesting, if you look all the way to the right, 2021 had the highest amount of commercial sales. Commercial meaning industrial, retail, office, multifamily. And land rebounded significantly. The green is what represents land. 2022, we actually had less transactions than 2021. 2021, we had 2,487 transactions. Last year, we had only 1,919 transactions, but we did $100 million more in revenue. The total revenue was approximately $1.1 billion for commercial and land in our area. As you can see with these numbers, 482 million just in commercial sales. It was down 26%. It's a result of interest rates, low inventory, and sellers not wanting to part with properties. The transaction count was also down, but land had a 24% increase in land volume. Again, $104 million increase year over year, but the transactions were down 22%. All activity, $1.1 billion, 2,145 transactions. Interesting, what is our niche in this valley? It's roughly $500,000 to $2 million when you look at commercial transactions. The sweet spot being roughly about $550,000, and it tapers down fairly quickly once you get over $5 million. Excuse me, yes, over $5 million. Less than 3% is over $7.5 million. So what I want to do is introduce Jerrad Schendel. Jerrad Schendel heads up our multifamily division with Bob Basen. He's going to come out and talk about what happened in multifamily last year, and he's going to talk about the future. Please give a warm welcome to Jerrad Schendel.
Good morning. How's everybody doing? Didn't sound that good, but we'll take it. So I'm going to go through this quickly because like all of you, I want to hear about the trains. That's why I'm here. Not to give this, but to go with trains. So we're going to go real quickly. This is the lows to the highs of what happened last year. As you can see, average 1.7, median 1.2. You had one big project that sold for 12.5. Nothing real spectacular there. The numbers pretty much correlate with what we saw last year. Slight increase, not much. The key thing that we want to look at here, though, is look at that last, it's kind of blurry, but that one right there in the middle. Time sent sales in months. So 7, 7.8, 7 is average, 7.8 is the median. That's what it's taking to sell apartments now. So the 120-day, put it on the market, multiple offers, that's done. It's back to a more healthy market. Properties are going to sit. They're going to take a little bit longer to go through. The other thing to pay attention to is the year built. 1974 average, 1982 median, right? So that is a good indication of what our housing stock is right here. Everything was built in the mid-70s to the late 80s. You scared me. So the number one question that I get pretty much every day is this the end? Are we done? Has multifamily reached the peak? Should we run for the hills, sell everything, hide in our bunkers? And the answer is no. But from the data, you can tell that the cap rates have compressed. They're pretty much done compressing. I do give that with one caveat on that forecast. That forecast was done a couple weeks ago. So if there's anything that kind of changes, you know, Chris Thornburg comes up here and says something different, we might see cap rates start to go up. But from general speaking, we are at where we're at from the cap rate side. So you're not going to continue to see property evaluation just merely based on cap rate compression. Sales price per unit, still up and up and up. 145 was the median. Nothing too exciting there. It's just pretty much continuing. You can see the big waves, though, and that's just because our market is so small relative that one large sale will change the data one way or the other. Vacancy rate. So this is a national average, and I wanted to point through the national average just to show you how good we are here. So start of COVID, 7.2, went down to 4.1. Every single thing had a COVID dip. Every market in the world that had an apartment building in it had a COVID dip on vacancy. Went back up to 6.1. If you go to us, we're significantly below that. So you can see our COVID dip under 2%. We are now at 4.3%. That is solid. That is no vacancy. 3% is kind of where we were headed over the last 5 years. We were right around 3 to 4. We're at 4.3. It has to go up because 4.3 isn't sustainable. So the numbers that you see climbing in the forecast up to 6%, I wouldn't worry about it. That's actually really, really healthy. And again, we go back to this slide. 6.1 is the national average. So we have room there, and we're going to continue with the vacancy rates. Rent growth has slowed. So I know you guys have seen a lot of articles. Oh, rent growth is down. Apartment market's in flux. Rent growth actually went up this year. It just didn't go up double digits, which is what everybody was excited about the last 24 months. So every year it has gone up double digits. Last year it didn't. So not that big of a deal. You're going to hear me say that a lot. Not that big of a deal. All the data is pretty much correlated to nothing to freak out about. So should we still invest? Is the market still a good place to invest in? So we obviously know that the end of the era is not happening. Are we going to see the price appreciations that we have seen? No. But we are going to see slow and steady growth. So you might want to take into consideration a couple of different things. Jason loves to make millennial jokes, and for rightfully so. So the median age for moving out is 26 right now. So done with college, enough life experience. Look at all the household formations that are coming up. 34 is the median average to buy a home. 26 is when you start. Where do you live before you buy a home traditionally? In apartments, right? So we have some room there. We have like a decade run of increased household formations, and that's not even including everything that you're going to hear from BNSF, everything that you've heard about all the industrial activity and all the jobs and economic activity that are coming this way. So that's exciting, right? Good long-term projections. And this shows optimism of investing in real estate. So this was a survey that was done for the percentage of landlords that plan to sell one of their units in the last 12 months. So 16.2% in January said that they plan to sell. Went down to 8.3%, and the reason for that is interest rates. So it's not because they were worried about anything or anything like that. In January of 2022, interest rates were still low, equity was high. We were doing equity on calculations time and time again. So we did so many return on equity calculations that those guys were planning to sell their properties, 1031 exchange, use their equity and cash flow. Well, what happened in July? Interest rates started creeping up. the excitement of doing that kind of slowed. So you went from, 16% down to 8% of people thinking about doing that. But on the other hand, the percentage of landlords that wanted to buy another unit was 37.5 down to 28% in October. That same correlation. It was 1031 buyers getting optimism. But 28% want to buy, 8% want to sell. I'm not great at math. I'm pretty good, but that shows a discrepancy there, right? And I want to pay close attention to the word plan to buy. That's not maybe. That's not, well, if the right deal comes along, no, that's plan. I have a plan. I'm going to do it. We're actively looking. We're working with lenders to kind of go through and do it. So there are some headwinds. There are some problems that we have. Anyone that's in the lending industry knows this. So I want to pay particularly close attention to the one on the very right side, the average 5-year. That's what most apartment investors will use. You can see 2020, 2.9%, barely under 3, 3.1 in 21, pretty decent, and then the huge jump happened, right? And we all know why that is. So we're going to continue to see those cost of capital, see what that does to the market, but it is making lenders more conservative. You're going to have to put more cash down to buy a property, which will ultimately affect the value, which is why you're not going to get those double-digit gains that you've been expecting and seeing over the last 5 years. The other thing is, I don't know if any of you have gone to Home Depot lately. Seems like everything's doubled or tripled in price. And if you call a plumber to your property, I know there's plumbers here, sorry guys, but it's more expensive than it's ever been. So the housing cost and the construction cost are going to continue to proceed. And what did we say in the very first slide? Most of our housing stock was built in the mid-'70s, late '80s, right? That's the time frame for most of our apartments. Those properties are due for major capital improvements. So that's some headwinds that'll happen here. You'll start to see whether landlords and investors want to spend the capital improvements or if they start getting ready to let some of those out. So the other thing we got to take into consideration is new deliveries. So these are some of the new projects that have been approved. I haven't gone through all of them because the cities will do much better at that than me. But you can see the Olive Tree Apartments, they're in their second phase. The first phase went well. They're on to their second phase of 93 units. Sonona, 42 units. The Eagle Housing still doing their 55 and older. Tamarisk, which is actually finaled now. There's 56 units there that are ready to go. Interesting thing that I'm sure Hesperia is gonna tout here when they come up and speak, but they're mixing with the C2 zoning to allow for some different uses. So that'll be interesting to see how that plays out. Victorville, you have the Lakeview Village, 272 units. Balsam, you have 212 units, again in Victorville. Victorville's getting creative with mixed use. There are 376 residential units in a mixed use facility. That'll be interesting to see how that goes, but the towns get it, the cities get it, everyone kind of sees that there's demand here for those kinds of things. And of course, Apple Valley with their 210 unit project on Navajo, it'll be the largest that's there. So that's not enough. That's not enough for everything that's happening. That's not enough even to support the community now if it didn't grow anymore with BNSF, with Brightline, with all of this economic activity. So your demand is just going to continue to increase without the supply. So recap, summarize. We'll get through this quick. Market, it's good. It's not great. It's not fantastic, but it's good. Long term, slow and steady growth. That's what we love. That's what we want to see. We don't want to see hyperinflation. We just want to see it slow and steady. Rent growth, again, 3.5% is kind of where you'll be at. Demand is going to outpace supply. So should we invest? Do we keep investing? Yes, if you are long-term and you're looking for a long-term area to invest in, multifamily is still a good way to go. With that, I will turn it back over to Jason. But if you guys have any questions for me, I'll be outside at the end of this thing. You can run it up.
Thank you. So I'm going to dive into the office market. Now, a lot of red on the screen. Red denotes bad. It's declines. But it's not that bad. Vacancy fell from 2.2% and went up, I should say increased to 3.4%. That's still an extremely tight market. Lease rates fell slightly, 3 cents, from $1.86 to $1.83, and absorption, it was negative 62,000 square feet. That was attributed to 3 buildings, 3 new medical buildings that are coming online, including the county's 27,000 square foot facility in Apple Valley that haven't been occupied. Once those are occupied, everything turns green, we go, it's a good market. Office has been a very stable asset over the last 20 years. There's roughly 5.6 million square feet. This is a breakdown by city. As you can see, the majority of it, 2.6 million square feet, is in Victorville, followed by Apple Valley at 1.2 million, Barstow at 600,000, Hesperia at 962,000, 139,000 square feet in Adelanto, and 44,000 square feet in the rural areas. This is a simple economics 101 graphic. This is a 22-year history of the office market. As you can see, in the last 5 years, vacancy rates have steadily declined as rates have increased. 101, the supply and demand. So we haven't seen much in the way of new construction for speculative building. It's all been owner use. And this is kind of gives you an idea over the last 10 years. The blue bars indicate new deliveries, new construction. And orange is just movement, positive, negative of space. And you can see it's just been steady over the last 10 years. Not much in new construction. As someone moves out, space gets backfilled, and it is a very stable, if not extremely tight market. This is a sales volume for office over the last 10 years, 22 years. Steady activity over the last 6 years, but interesting, the blue line denotes the price per square foot, which has continually rise since the Great Depression. I said it again, it's recession actually, but it felt like a depression. There were some transactions, but very few. The activity in office was approximately $40 million. This being one of the top transactions, which is a medical building, which is a sale leaseback, traded for almost $2 million, $260 a square foot, attributing to the steep increase in the price per square foot. We sold our building last year. We moved to the corner of Industrial and Bear Valley. The building was repositioned to a dentist's office for their corporate headquarters of 7 locations. I think someone said earlier we sold too soon on the Walmart building. We sold this at the beginning of 2022. Just to give you an idea, the office market got extremely tight. If we would have held on to the building for probably another year, we would have probably seen another $200,000 to $300,000 in sale price. And this is a very interesting transaction. It's a smaller building in Apple Valley, approximately 3,500 square feet. It was a sale leaseback to a national REIT that bought the building, paid $1.56 million for $447 a square foot. It's a record number. So the office market, there's a steep decline over the last 10 years. The pandemic, we all moved to Zoom. I said this last year. That should have devastated the office market, but we just don't have enough office space to be decimated. In fact, our office space not only remained strong, it actually had a declining vacancy rate. Again, I talked about the absorption of space. Last year, we absorbed approximately 60,000 square feet, negative 68,000 this year. Again, that's attributed to 3 new buildings coming online. Vacancy rates declined steadily except for the last year. But again, anything under 6% vacancy rate is an extremely tight market. The lease rates didn't move much, $1.86 to $1.83. We have approximately 64,000 square feet of new office space. And if you look at the trend over the last 5 years, we've been delivering anywhere between 40,000 to 65,000 square feet of new space, and it's all leased out or built to lease prior to the shovel going into the ground. The office tenant delinquency rate has remained less than 3%. People are paying their rents. And medical buildings dominated the sales last year, as they did the year before. So let's jump into retail. Retail, interestingly, had a bigger year than industrial. Everything we've been talking about, everything we're going to talk about today is industrial. We see large buildings going up. We see a lot of activity. But interesting, retail outpaced industrial last year. All green. Everything was good. Vacancy rates fell from 6.7% down to 5.2%. Lease rates increased from $1.31 to $1.36. And again, 288,000 square feet of positive absorption. The prior year was over 250,000. We continue to absorb retail space. See the numbers, I won't read them, but Victorville has the largest portion of retail space, followed by Hesperia, Apple Valley, Barstow. There's approximately 18 million square feet of retail space in the high desert. And this is a quick chart. Again, we're going back to Economics 101. The last 5 years, we've continued to deliver new space, absorb new space. Rental rates have gone up, vacancy rates have dropped. So it's been a very steady and stable retail market. Again, another graph. The blue denotes new deliveries of properties. As soon as they're built, they're absorbed. As you can see, the orange bars don't drop below the line except for 2015. That means and 2019 just a little bit, just a smidge. In other words, very rarely have we ended a year where we've had negative absorption. We've been delivering new retail space, we've been absorbing retail space. Sales volume has been consistent almost for 10 years. Last year, again, was about $162 million, consistent with the year before. Price per square foot has continued to go up since 2013. That's 10 years of per square foot price increase. Notable transactions were Planet Fitness. Interestingly, this was on the market for over a year. Sold at a 6 cap rate, 17,000 square feet for $5.24 million. This transaction was great. I reported on this center. This is a Vaughn's shopping center on the corner of Bear Valley and Hesperia Road. The building sold last year for $155 a square foot, 7.91 cap rate. They're breaking the property up. They repaved the parking lot, and they put some paint on the building, and now they went from $155 a square foot to selling it for $260 a square foot in 1 year. Cap rate 6.25%. This was a good add value property. This is another property in Hesperia that sold on Main Street. Interestingly, they sold a 7 cap rate. It was on the market for a year and a half. Mainly it was related to tenant issues. The building finally got sold with full occupancy, but the cap rate was stronger than anticipated. And this vacant building for 10 years, the former Albertsons, finally got sold. And the primary issue with this was there was a restriction by Albertsons. And this happens when a grocery store vacates, they put a restriction that another grocery store cannot go in to compete against them in another part of the market. Once they lifted this restriction, the building did sell. If you look at the days on market, 3,459 days. Now, as a real estate broker, you got to be patient. Talk about talking to your client. Oh, any activity? No. $63 a square foot, a new grocer's going in there. It was bought by Superior Grocers. El Tío Pepe's. I have to deliver the bad news. We sold the building. It is going to be torn down after all these years. So, interestingly, is the value. It sold for $432 a square foot, 6,000 square foot building. $2.62 million represents land value. That's how valuable that corner is. So, we don't know what's coming. Probably a gas station, car wash. I think that's the only thing we know how to build, right? I think they think we have really dirty cars in the desert. So the vacancy rate dropped dramatically down to 5.2. As mentioned, the lease rates increased. Interestingly, though, the lease rates did not increase in step with CPI. CPI last year, depending on what month, was anywhere between 6 and 8%, so the rents did not keep up with CPI. 187,000 square feet of new space was absorbed, including 61,000 square feet of new space. Power centers dominated. Power centers is the super Walmart, the super Targets, the large centers which have everything, including a car wash. That is where the concentration is. The problematic area has been in the neighborhood markets. And if you look 5 years ago, we were at an 18% vacancy rate in the neighborhood strip centers. It's fallen to 11, but the majority of the retail space that's open is in neighborhood centers. And we've had a steady decline in retail since 2015, interestingly, while absorbing over 500,000 square feet in space. Land had its best year last year, without doubt. $528 million in sales. Again, these graphs. By the way, if you live and die by land, you died in 2008, and then you're resurrected in 2019. It's a tough market, but we have a lot of land. That's what we dominate up here. Interesting, as you can see, we still did not hit the peak that we hit in 2005 in land sales. We came damn close. We're trying. So again, a lot of activity, but what was interesting is the transactions were down. The average sales price on a land transaction last year was $275,000. When I saw that number, because I ran that before I actually looked at all of the sales, but it was really skewed by one sale of $87 million for 65 acres. It wasn't a cemetery either. It was industrial land. It was sold to Westcor Properties out of La Jolla, and you've seen it. If you've seen a very small building of 1 million square feet going up in Hesperia, that's the property. So again, it did increase the per transaction price, and that did skew the numbers for last year. But still, $528 million in activity, a great year for the high desert. Interestingly, the days on market did increase. The average days on market was 154 days in 2021. That increased in 2022 to 204 days. It's a 35% increase on days on market. Again, it denotes a slowing market. Transaction volume declined. I talked about sales volume did increase, which was great, but new housing starts actually declined 37%. I was actually surprised at this number. And I think it's really builders who reposition. If you read the news on builders, builders pulled back in 2022, quicker than they've ever pulled back. And I know why. Builders got hammered, hammered in 2007, 2008, 2009. I remember talking to a KB Homes rep about 5 years ago. He said, "We hate the high desert, we lost our ass, but if you have any good land, call us." They're skittish. And the first time they heard a glass break across the nation, they all pulled back, walked away from deposits, held off on opening new tracts, and we were also affected by that. The prior year, we were over 1,000 units delivered, 781 last year. Interestingly, we've seen that increase in the first quarter of this year. We're only in March, but we've seen new starts increase. By the way, October, November, December. We're going to have the city up here in a little bit. I'm sure they were working a little bit in the planned apartments, but I expect it was fairly quiet compared to the first half of 2022. Multifamily, as Jerrad talked about, it's still not meeting the demand that we have. Currently, between the 5 municipalities, there's 1,565 units, either under construction or planned. And industrial space. Again, retail was very busy, but from a land transaction, industrial dominated last year. There's approximately 19 million square feet either permitted, under construction, or being spoken about. Land activity does remain focused on industrial, and even though there was a pause on residential, there is still a healthy market on the residential side of it. Capital markets, investment properties, very interesting year for capital markets. This is a cap rate analysis, a return on properties versus a 10-year treasury note and mortgage rates. Now, if you think mortgage rates are going to increase, you would think cap rates would increase. They held steady all year long. If you look to the right of the chart, you notice that mortgage rates exceeded cap rates. The 10-year treasury bond got fairly close, which is astonishing, especially some of the properties I'm going to show you, traded as low as 3.4% cap rate. That means you buy $1 million property, you get $34,000 a year. I'm not plugging a bank, but I can go to Alaska USA and get 4.15% on a CD. Why would I take the risk with a tenant, a property, repairs, when I can just park my money in a CD? Obviously, there's other issues, the tax, depreciation, there's future appreciation of the property, there's rent increases. But again, cap rates were unaffected last year. I think that's going to be different this year as people actually have to put a mortgage on that commercial property that's higher than the cap rates. Price distribution on cap rates, percentage was roughly between 4 and 6. The sweet spot last year was 5%. Interestingly, where are our buyers coming from? The blue line is local. Local is buying at a higher cap rate than national buyers. The green line is actually foreign buyers. Why are foreign buyers buying at a lower cap rate than national or local investors? The U.S. is a safe haven for funds. Their primary goal is not necessarily the return on the cap rate, it's a safety that the U.S. provides in real estate. Oh, and then cap rate. 65% of the purchases in the high desert were private party. Users, 13%, and approximately 22% was national REITs or private equity. Notable transactions, 83,000 square feet, Village Center near Hobby Lobby, sold for $13 million, $156 a square foot, and 6.45% cap rate. This property was on the market for 3 years. The shops at Walmart, this is 395 and Palmdale Road, 9,000 square feet, $600 a square foot, $5.4 million. But interesting, the cap rate was 5.83, which is a pretty decent cap rate for national tenants. Raising Cane, 3.77. I mean, yeah, 4.9 million. What a great number. It's 3,000 square feet. 3.7% cap rate. Still, 2022, people are paying money for low cap rate properties. This is a center in Barstow at the new Super Walmart. It's one of the out parcels. 5.6, it was on the market for almost a year and a half, sold for $4 million. And the lowest one, 3.4 as mentioned earlier, Phelan, California. And this was not even for a new building. This was for a McDonald's that was built in 1998, and they renovated last year. McDonald's signed a new lease. They sold it for $3.18 million, almost $700 a square foot. I think McDonald's is the gold arches, better than gold. Cap rates remain stable despite rate hikes. Credit tenant properties sold as low as 3.44. The average cap rate last year was 5.2%. Buyer exceeded sellers. The demand that buyers had exceeded the available inventory that we had. Commercial mortgage rates increased approximately 225 basis points last year. 2.25%, yet the cap rates remain stable. And we anticipate cap rates to increase in 2023 as mortgage rates drive return down. So, year in review, $1.1 billion in sales. Almost 50% of the transactions last year were land related. As you've seen today, large format industrial dominated our not only development but also our sales volume. New housing starts did decline 36%, but we're hoping that does increase this year. Again, we're underbuilt not in the nation but also in the high desert. And interestingly, unlike the 2000s, speculative development is non-existent. 2004, 5, 6, I built a 14,000 square foot strip center, and then I would say, I'm open for business. Anyone want to lease it? Banks would give me money. It was absolutely easy. This go around, you cannot get funds from a lender to build a building on spec. They want it completely leased out, which is why we've seen very low speculative activity in the market. One of the things that favors us going into a slowdown is our affordability index. We have the most affordable housing in Southern California. That's going to be attractive. Couple that with Zoom, the ability to commute. Maybe you only have to go down the hill once or twice a week. That is a positive for us. Again, as I mentioned earlier, new housing starts increased in the first quarter of this year. We have 1,565 apartments currently in development. Investments are slowing, but that is not as a result of demand. That's low inventory and low rates, which haven't met mortgage rates yet. Retail development still remains in infill locations, filling in either a Super Walmart or a Target or in Bear Valley or Main Street. The office sector is stable. There is no inventory. Typically, that's the sector that gets hit first in a recession. We see that as remaining stable, and we believe the housing market, even though they're predicting a slowdown in the housing market, which we've actually seen over the last few months, again, we're underbuilt. We have extremely low inventory, and I don't mean to steal Chris's thunder. She'll talk about inventory in a little bit. External influences. Recession. But what's more interesting is continued inflation can erode consumer confidence. My advice, don't watch the news. Turn it off. Watch cartoons. South Park is much better. More factual. I'm not going to take Dr. Thornburg's thunder. He's going to get into Fed tightening, rate hikes, if there is a decline in consumer spending. But again, some of the external influences that could affect us also include not only our economy, but possible global conflict. And it's going to be very interesting what the state of California is going to do to backfill the deficit. We were extremely wealthy flowing with money the last 3 years. All of a sudden, we don't have that money. It disappeared, and we have a $22.5 billion deficit in the state of California. They'll forget they got that money, and they'll start talking about taxation. That'll be interesting over the next few months. Forecast for 2023, I think we just use a magic 8-ball. Anyone grew up with that? I think it's the most effective way to predict in 2023. Land activity will continue to be active, especially in the industrial market. Lease rates have increased to help deliver new industrial space under 100,000 square feet. As you heard Bob Basen mention earlier, there is no space. We have people coming to us asking for 10,000 square feet of industrial space, and we have to scramble to find it. There is no inventory. Retail development to continue, but at a slower pace. Cap rates, again, will increase. Rental rates to remain stable because we have extremely low inventory and low vacancy factors. And a slowing economy could impact the office market, but again, we're only at 3.4% vacancy rate, very low. And multifamily is going to continue to expand to meet the demand that we have. So, if I can ask for a future, I'll just take a recession light, drink it real quick, and we move right on. Anyone in agreement? Thank you very much.